IFC Markets. I'm going to introduce a weekly market overview made by IFC Markets. Let's start. March ended, and we can now sum up the first quarter of 2013. The US dollar was stronger than other major currencies in the first 3 months of the year. The US dollar index rose by 4.4% in many respects due to broad weakness of the yen and the pound, which lost 7.5% and 6.9% respectively. The results of the two European currencies are slightly better. The franc with -4%, euro -3.3%. Those were commodity currencies that behaved best against the US dollar. The Canadian dollar having dropped by 2.9% and the Australian dollar with a -0.4% from the beginning of the year. Last week, Cyprus remained one of the most discussed issues. The nation gained financial aid from the troika of international creditors, but had to agree to transfer a part of losses on large investors with deposits of more than 100,000 euros. According to the latest data of the central bank, their losses can reach 60%, which is significantly more than initially announced from 30 to 40%. And despite all the uniqueness of the Cyprus case, the precedent is a medium-term risk factor for the single currency, dropping last week to a 4-month low at 1.2750. Recalling political instability in Italy, which still remains without a government, and deteriorating macro statistics in the region, we see the next target at 1.2680, 7-month low, and 61.8% FIBOR level can be reached in the nearest future. The current week can be certainly called the week of the central banks. On Tuesday, the Reserve Bank of Australia will open the parade, and on Thursday, 3 meetings will complete at once. Early in the morning, the Bank of Japan can make changes in the monetary policy, and this will be the first meeting for the new chairman, Haruhiko Kuroda. Then the word will go to the Bank of England and the ECB. However, significant changes in the policy are being expected only from the Bank of Japan, in switching to a more active monetary stimulation. It could be a key point for the yen. Over the last 6 months, the currency has lost more than 20% against the dollar, and still the movement has been largely driven by a rhetoric from Prime Minister Abe and the bank's new chairman Kuroda. Further fall of the yen will now depend on how decisive the central bank will sound for overcoming deflation. As to a great extent, measures can be already priced in. We expect at least an increase in asset purchase program and its expansion to include 5-year bonds. But even if the bank disappoints, we are more prone to think that the yen will not fall below the support at 91.30 per dollar. Taking into consideration the contrast between expansionary monetary policy in Japan and, on the other hand, already existing discussions of the quantitative easing cuts in the US, our medium-term view for the yen remains negative at the moment, with the next targets at 96.70 and 97.70. Market sentiment indicators confirm our projections. The U.S. Commodity Futures Trading Commission reported on March 29 that the net short speculative position on the yen rose and remains the largest among the 6 major currencies, and despite a 2-week correction of the dollar-yen pair. In addition, futures market participants continue to hold net short speculative positions on the euro and the British pound, and both have increased as well. The only currency among the 6 major holding a net long position against the dollar remains the Australian dollar. Weekly market overview was with you. Follow us every Monday. We wish you a productive and fruitful trading. Bye.